Imagine this. You're walking down the street, and there's a $500 bill just lying there on the sidewalk. But here's the thing. You walk right past it, every single year, and you don't even know it's there. Sound crazy? Well, that's exactly what's happening to millions of people when it comes to their banking relationships. Banks reward customers who keep $50,000 with them very differently than everyone else. And most people have absolutely no idea. Here's what's wild about this. According to the Federal Reserve Survey of Consumer Finances from 2022, the median transaction balance across all Americans is just $8,000. $8,000. If you're between 45 and 54 years old, that number jumps to $25,000. And if you're in the top 10% of income earners, you're sitting at around $104,000. But here's the psychological trap we all fall into. Most people assume these banking perks, these rewards programs, they're for millionaires. They're for rich people. They're not for me. Right? Wrong. The reality is that many banking programs have meaningful escalations right at the $50,000 mark. And that's a threshold that's actually reachable for middle-income earners. So right now, I want you to think about something. Roughly how much do you keep across all your accounts? Your checking, your savings, your investments? Are you under $10,000? Are you somewhere between $10,000 and $50,000? Just think about that number. By the end of this video, you're going to know whether chasing that $50,000 threshold is actually worth it, or if it's just clever marketing designed to keep your money locked up with one bank. Let's break down what $50K actually unlocks. Let me tell you about Sarah. She's 32 years old, makes about $75,000 a year. She's doing pretty well. She keeps $22,000 in her savings account, $18,000 in her investment accounts, and about $8,000 in checking. If you add that up, she's got $48,000. She's so close to that $50,000 mark, but she doesn't realize that consolidation actually matters. So what happens when you cross that threshold? Let's look at some real programs. Bank of America has something called Preferred Rewards Platinum. To qualify, you need a 3-month average balance of $50,000. What do you get? Your credit card rewards get boosted by 50%. So if you're earning 2% cashback, boom, now you're earning 3%. All your monthly checking and savings fees? Gone. Waived completely. And they'll reimburse you $10 a month in ATM fees when you use out-of-network ATMs. U.S. Bank has their Smart Rewards program, and the gold tier kicks in at the $25,000 to $99,000 range. With that, you get monthly maintenance fee waivers. That's $12 a month, which might not sound like much, but it adds up to $144 a year. Citibank's priority banking escalations also happen around that $50,000 combined balance mark. You start getting access to dedicated support, better loan terms, the whole 9 yards. Now here's what the banks understand about human psychology. They call this relationship banking. The idea is simple. They want you to consolidate all your assets with them. When all your money is in one place, you feel loyal to that bank. You're less likely to leave. And in return, they reward those higher balances. Think about your own situation for a second. Would you move accounts if it saved you $500 or more per year? Most people would say yes immediately. But then they never actually do it, because it feels like a hassle. But here's the real question we need to answer. Are these perks actually worth parking $50,000 with one bank? Let's do the real math. Okay, let's get into the numbers. If you spend $1,000 per month on a credit card that earns 2% cashback, here's what happens. Over a year, that's $12,000 in spending. At 2%, you earn $240 in cashback. Now, if you hit that $50,000 threshold and get that 50% rewards boost, you're suddenly earning 3%. That's $360 a year. The difference? An extra $120 annually just from that boost alone. But that's just the beginning. Remember those ATM reimbursements? $10 a month. That's another $120 a year if you actually use out-of-network ATMs regularly. And those maintenance fee savings we talked about, That's roughly $144 annually. Add it all up. You're looking at somewhere between $384 to $500 per year in visible perks, just from consolidating your accounts. But wait, there's more. The FDIC has noted that many banks offer better loan terms at that $50,000 consolidated balance level. We're talking about 1/4 to 0.5% discount on auto loans. Let's say you're financing a $30,000 car. That discount could save you around $1,500 over a 5-year loan term. Now let's talk about compounding, because this is where it gets really interesting. If you're earning even a modest 2% APY on your $50,000, and you're reinvesting those perks we just talked about, the compounding difference over 10 years adds up to approximately $5,000. That's not chump change. Here's the psychological trap, though. Small percentage differences don't feel significant in the moment. 0.5% on a loan? Who cares, right? But these differences compound heavily over time. They add up in ways that our brains just aren't wired to appreciate in real time. So let me ask you this. If you could earn an extra $500 a year with zero extra work, would that change how you structure your accounts? Would it be worth consolidating? For most people, the answer is yes. But here's where it gets even more powerful. It's not just about fees and cashback. The biggest benefit of hitting that $50,000 threshold? It's not the cashback. It's not even the fee waivers. It's behavior. Vanguard did some fascinating research on this. They found that people with dedicated financial advisors, which you often get access to at these higher banking tiers, they reduce their investment mistakes by 10 to 15% annually. And over the long term, these participants show 20% higher retirement savings. Let that sink in. 20% more in retirement savings. Not because they earned some massive return, but because they avoided costly mistakes. They didn't panic sell during a market downturn. They didn't chase hot stocks. They stayed the course. Morningstar has similar insights. They've shown that when people get boosted rewards and they reinvest that money, even just $500 annually, it makes a major difference over decades. We're talking tens of thousands of dollars by the time you hit retirement. But there's another psychological component here. When you're treated as a priority customer, when you have a dedicated advisor, there's an accountability effect. You're more likely to actually follow through on your financial goals. You feel like someone's watching, someone cares, someone's there to guide you. And here's something nobody talks about. Higher-tier customers tend to have fewer overdraft incidents. You know what an overdraft fee costs. $35 on average per event. If you've had a few of those hit your account over the years, you know how frustrating it is. So let me ask you, have you ever paid an overdraft fee? How much did it cost you? More importantly, how did it make you feel? Probably pretty annoyed, right? Well, when you're in a higher tier with better account monitoring and dedicated support, those incidents drop significantly. The behavioral edge is real. It's measurable. And it's one of the most underrated benefits of consolidating your assets. But here's the thing. Not everyone can or should rush to hit $50,000. Let's talk about who actually reaches this threshold and why it matters. Let's look at the data from that 2022 survey of consumer finances again. The median balance overall across all Americans is $8,000. For people aged 45 to 54, it's $25,000. And for the top 10% of earners, it's $104,000. What does this tell us? Most Americans are nowhere near $50,000 in liquid assets, but a significant portion of middle to upper middle income households are within striking distance. Here's where it gets uncomfortable, though. Research from Morningstar on wealth gaps shows that women and minorities are significantly underrepresented in these higher banking tiers. The system rewards consolidation and long-term savers, but not everyone has equal access to build that wealth in the first place. This creates a compounding advantage that actually accelerates inequality. If you can hit $50K, you get better perks, better loan terms, better advisory support. That helps you build even more wealth. If you can't, you pay more fees, you get worse loan terms, and you're left to figure it out on your own. Studies show that banks see a 15 to 20% improvement in customer retention at these higher tiers. Why? Because once you're in, you're getting enough value that it feels painful to leave. You're locked into the ecosystem. But here's the empowering part. The system rewards consolidation and long-term savings, yes. But middle-income households can realistically target $50,000 over time. It's not just for the wealthy. It's a milestone that's achievable with strategy and discipline. So think about your own situation. Do you think $50,000 feels realistic in 3 to 5 years? Or does it feel too far away? Be honest with yourself. Because if it feels realistic, there's a path forward. And if it feels too far away, we need to talk about whether chasing these perks makes sense for you at all. So, how do you strategically reach 50K without sacrificing flexibility? Let's get into the strategy. Alright, let's get tactical. If you've decided that hitting $50,000 is worth pursuing, here's how to do it smartly. First, you need to calculate your 3-month average balance. Most banks don't just look at a single day. They average your balance over 3 months. That means you can't just park money there for a day to qualify and then move it out. You need sustained balances. Second, consolidate strategically. Pull together your checking account, your savings account, and yes, even your investment accounts. Many banks count brokerage accounts toward that $50,000 threshold. So if you've got $20,000 in savings, $15,000 in a brokerage account, and $15,000 in checking, congratulations. You qualify. Third, automate your transfers. Set up monthly automatic transfers to build toward that threshold if you're not there yet. Treat it like any other financial goal. You can't manage what you don't measure. Fourth, compare your base rewards to your boosted rewards. Run the actual numbers for your spending. If you only spend $300 a month on your credit card, that rewards boost might not matter much. But if you're running all your expenses through one card, that boost could be substantial. Fifth, track the annual value of your perks. Write it down. Add up the fee waivers, the cashback boost, the ATM reimbursements, everything. Once a year, look at that number and ask yourself if it's worth keeping your money consolidated. And sixth, monitor grace periods. Most banks give you a 12-month grace period if your balance drops below the threshold temporarily. Life happens. You might need to pull money out for an emergency. Understand the rules so you don't lose your perks unnecessarily. Let me give you a real example. A family combines their $20,000 savings account, $15,000 brokerage account, and $15,000 checking account. Boom. $50,000. They qualify. Now they're getting all those perks we talked about. Here's the psychological shift you need to make. Don't think of $50,000 as a restriction. Think of it as a milestone. Money with purpose feels motivating. You're not locking up your cash for no reason. You're strategically positioning it to work harder for you. So let me ask you, would you consolidate accounts to hit a financial milestone? Would it feel like progress, or would it feel like giving up flexibility? But before you rush to move all your money around, we need to talk about something important. There are times when chasing $50,000 doesn't make sense. Here's the reality check. If you have high-interest debt, anything from 6 to 20% interest rates, you'll get a much better return on your money by paying that down instead of chasing banking perks. Think about it. If you're paying 18% on a credit card balance, saving $500 a year in banking perks is meaningless. You're losing way more than that in interest every single month. Pay off the debt first, then worry about optimizing your banking relationship. There's also opportunity cost. If you can earn higher returns by investing that $50,000 elsewhere, like in index funds that historically average 7 to 10% annually, then the banking perks might not be worth it. You have to run the numbers for your specific situation. The key is this. Your perks must exceed the alternative returns you could be getting. And you need to evaluate this annually because things change. Interest rates change. Your spending habits change. The programs themselves change. Here's the psychological trap to avoid. Don't chase status. Don't consolidate just because it feels fancy to be a Preferred Rewards Platinum member or whatever they call it. That's ego. That's marketing working on you. Make the decision based on math. And don't lock up cash unproductively. You need emergency savings. You need liquidity. If hitting 50K means you have no cushion for unexpected expenses, that's a terrible trade-off. So ask yourself, would you rather chase perks or maximize returns? There's no wrong answer. It depends entirely on your situation. But be honest about what you're actually optimizing for. Let's wrap this up. I'm going to give you a simple framework to make this decision for yourself. All right, let's recap everything we've covered. The $50,000 threshold unlocks measurable perks. We're talking $500 to $1,500 or more in annual impact when you factor in fee waivers, rewards boosts, ATM reimbursements, and better loan terms. Then there's the compounding effect. Those loan discounts, those reinvested rewards, that advisory support. Over 10, 20, 30 years, this stuff adds up to real money. And don't forget the behavioral advantage. Having a dedicated advisor, being treated as a priority customer, avoiding costly mistakes. That matters more than most people realize. So here's your framework. Before you make any moves, ask yourself 3 questions. Question 1. Can I reach $50,000 without harming my liquidity? If getting to $50K means you have no emergency fund, the answer is no. Don't do it. Build your safety net first. Question 2. Do the perks exceed my opportunity cost? Run the actual math. Add up the benefits. Compare them to what you could earn by investing that money elsewhere or paying down debt. Which number is bigger? Question 3. Will consolidation actually simplify my finances? If you're currently juggling 5 different banks, and this brings it down to 1, that's valuable. Your time has value. But if you're consolidating accounts that were working fine just to chase perks, maybe it's not worth the hassle. Here's the empowering truth. $50,000 isn't about status. It's not about bragging rights. It's about leverage. It's about making your money work harder for you within the banking system. And middle-income earners can strategically target this. You don't have to be wealthy. You just have to be intentional. So now I want to hear from you. Comment below. Are you chasing 50K? Are you already there? Or are you rethinking this whole thing after watching this video? And if this changed how you see your banking relationship, do me a favor. Share this with someone who keeps cash sitting idle across multiple accounts without realizing what they're leaving on the table. Oh, and one more thing. Next time, we're going to tackle the $100,000 wealth acceleration tier. Is it exponentially better than 50K? Or is that where the returns start to diminish? Stay tuned. Thanks for watching.